Welcome to Stock Shotz. Tonight, our guest is John Williams. John is a consulting economist for Fortune 500 companies and is the founder of shadowstats.com. Please visit John's website at www.shadowstats.com. Please visit our website at www.stockshotz.tv. That's www.stockshotz.tv. Thank you for listening.
We're so pleased to have John Williams back as our guest tonight on Stock Shotz. John, thank you so much for coming back on the show.
Always a pleasure. Thank you for having me.
John, last time that we talked, you were talking about how the Fed had quit tracking M3, but the numbers were still there, and you were still tracking that stat. You stated that we were seeing year-over-year growth of about 16.9%, which was the highest in the series.
Right.
Now, we spoke about 6 weeks ago. Has anything gotten better, or could you elaborate on where we are at this point?
Well, as of March, and the Fed does revise its numbers, and the underlying numbers here are all from the Fed, so when they revise their data, it can affect our estimate of M3. For February, we're looking at 17% growth, and March it's was 17.4%. Again, well over the prior record high, which was 16.4, I believe it was back in 1971. June of 71, a couple of months before Nixon closed the gold window and instituted wage and price controls. It looks like it might be slowing down a little bit in April. We don't have final numbers yet for April, but it might slip below 17%. That remains to be seen. The last time we had a somewhat softening in an otherwise very strong rate of growth was back in December, which is when the banking solvency crisis was coming to a peak and forced the Fed to take some very specific actions in terms of adding liquidity to the system. And the fact that the Fed moved a week or so ago to expand that liquidity again is probably related to that, and I would expect that you'll see the numbers turning higher still in the month or two ahead.
So even though you're saying we may slow down in April, it's fair to say that based on our last conversation, this is still a very dire situation.
Yes, this is, I mean, if we slow down to, let's say, 16.6%, it's still, I mean, shy of what we've seen in the gyrations of the last month or two, an all-time high. So it does have implications down the road a year or so for a substantial pickup in monetarily driven inflation. We should actually be seeing some effects of that later this year.
Well, and that was one of the things that I wanted to talk to you about. Last time, you noted that a lot of the inflation that we were seeing was coming from the oil and other commodities,
yep.
That's where the pressures were coming from, and that we had not seen this Fed-created monetary inflation yet because of the track that it, the time frame that it takes to see those pressures.
That's correct.
So do you still think that the monetary inflationary pressures are yet to come?
Oh, yes.
Okay.
As well as some of the inflationary pressures from the weak dollar. Dollar's had some rally recently, along with some other crazy moves in the market, but the basic underlying fundamentals have not changed at all. If anything, they've gotten worse. We're still in a deepening inflationary recession. The liquidity crisis, or the banking solvency crisis, is not over, despite declarations to the contrary. And the general outlook in terms of what we were talking about the last time has not changed. You have had some wild gyrations in the markets with selling of gold, buying of the dollar, rallies in stocks, and also volatility in stocks. But it is the underlying fundamentals remain extraordinarily bullish over the long term for gold, very bearish for the dollar, and I can't for the life of me come up with a good scenario for stocks, but that market isn't always too rational.
Well, and that was another thing that I wanted to talk to you about. When when we spoke last time, it was right after the Fed had come out, a day or less than a week after the Fed had bailed out Bear Stearns. Now, prior to that time, it seemed like the stock market had no confidence in the Fed. We were hearing chatter of traders wanting to abolish the Fed. Jim Rogers, who was a guest on our show, had said the Fed should be abolished. We kind of went...
Not a bad idea, but probably not a good time to do it. You have to let the current situation run its course. But
that's true. We did find some value in what they did, at least over the short term. And the markets overnight went from we don't trust the Fed to the Fed has got our back, everything is okay, and we've seen a pretty good rally. And initially when that started, I thought, well, we're coming off of a terrible first quarter. We're seeing some money flow back into the market. This is going to be a short-lived rally, but it continued through the month of April, and over the past few days has even been fairly decent. But did the Fed do anything in your mind to change the landscape like that?
Well, they have avoided so far, successfully, a collapse in the banking system. So that is a plus. On the other hand, the system is not stable. The cost to the system of what they're doing to prevent the collapse is inflationary, highly inflationary, which is long-term negative for many financial instruments. And in terms of everything's just fine and dandy, that's a fairy tale that's spun by the storytellers on Wall Street. What you have to keep in mind here is that we're looking at probably the greatest threat to the financial system seen since the banking collapse in the 1930s. You're looking at something here that very easily could be classified as a threat to national security. I mean, this is the type of thing that could bring down financial institutions, implode the money supply, give you deflationary depression. The Fed's doing everything that it can to keep that from happening. But you also have to remember that the Fed is part of a team that works to maintain market stability, and a lot of that's psychological. Some people call it the plunge protection team, other the President's Working Group on the Markets. I think that's the formal title of it. But this is a group that's headed by the Fed Chairman, Treasury Secretary, and others. I think the head of the SEC, some institutions that are being abolished as part of the Treasury's reorganization plan of the financial market oversight. But what they do is they come up with ways of trying to mollify the markets, to put out a plan to keep things contained. And I've heard stories of analysts on Wall Street being told not to issue critical comments on financial institution stocks. You're getting a very well-coordinated story that's being told and retold by a number of senior people, Treasury Secretary Paulson, I believe in the last day or so. But it's a story. It's aimed at pacifying the markets. But you look at the underlying numbers. You look at the real world, the way the real world is responding, and there's very little evidence there to support the official line that happy days are indeed here again.
For the rest of this video, please visit our website at www.stockshotz.tv. That's www.stockshotz.tv. Thank you for listening.